So today I wanted to bring on my broker, Jared. Jared has been working on my portfolio for maybe the last 7 or 8 years. So all the magic you see in my portfolio getting to where it is today has actually come from Jared, structuring my portfolio, strategizing with myself. I think we strategize pretty much on a weekly basis on how to keep moving forward. And I think that, with all these changes that have happened, I've got a lot of people talking around different structures, what the banks are doing, what's the best structure for them. And I think there's a lot of misinformation out there because there's so many strategies right now where everyone's like, just go buy company structures, exclude the entity, keep moving forward, you're all good. And I don't think that that is as simple as it is. And I think there's a lot more complexity to that, and it depends on the situation. So I really wanted to have sort of a fly on the wall conversation with Jared, which we usually talk back and forward on all of these structures and what the best way is forward. And I wanted all my clients and all of my followers, everyone to sort of see that, what we talk about so that I guess, everyone else can get such a benefit from how we are talking in the background when no one else sees it. So, obviously, welcome, Jared. And I
Thanks,
guess
mate.
we'll start off with the banks. What's been probably the biggest changes we've seen in the last few weeks?
In the last few weeks, well, that's probably more around obviously the government and their budget changes.
Yeah.
The banks, brokers, everybody, they're governed around being responsible when they lend a loan to you. I guess what's that's triggering is pretty much all the banks going, and non-banks by that extension, is if the clients cannot get negatively geared properties on their calculation of their borrowing capacity or their cash flow, can we actually factor those into the capacity calculations?
So pretty
So
much what they've done, which is what we've seen them scrambling, which is taking negative gearing out of the calculators. However, uh, people, I guess banks like Macquarie have started adding back some form of negative gearing back into the calculators for these existing properties. How does that work?
yeah, I guess it comes down to the individual calculator. I guess what Macquarie has a good calculator in that it's a bit malleable in the way that there's a method in where you can isolate the negative gearing to the rental income that you earn on the property. So it's not that you lose the negative gearing entirely. What you do lose is the negative gearing add back
Against
to
you?
your personal income,
Yes.
but you do get the add back in terms of the rental income that property is producing. However, some lenders don't have the luxury of a nice calculator like that they can immediately roll these changes out. So it's a bit of a Mexican standoff at the moment between the lenders. Some are pulling triggers in terms of coming out straight out the gate, like Macquarie came out straight out the gate, no more negative gearing from this date, blah blah blah. And then there's just been trickles of lenders and talks behind the scenes. BDMs of banks are telling us it's on the table, it could be imminent. These changes will happen pretty much across the board to pretty much all lenders.
Some lenders though are saying that they're not changing anything just yet until it passes through the Senate,
Yeah,
essentially until they feel that the changes have happened. So there is a period of time where some of these, some clients of ours, for example, that are buying properties that we're squeezing through that may not be able to buy the same type of property within a few weeks. We're able to squeeze them through right now. So some of the calculators have changed. It sounds like everyone, I mean, all the banks are going to try and get as much borrowing capacity as possible for investors. So it sounds like they'll probably all end up in the end somewhere near Macquarie's type of calculators where they're adding back some of the rental income, but just not adding back the negative gearing add backs against your personal income. So, or the tax back, right? So it seems like they're trying to work it out. So without the negative gearing, in the calculators, I think we were dropping like 40 odd percent on average. And I think it's now worked back with Macquarie's new calculators, what, circa 20% depending on the price.
yeah, correct. And I guess it's highly dependent on the income of the person. You know, if you're only on a lower wage, your marginal rate might be lower. The amount of tax you pay is less. Therefore, the negative gearing add back would have been less anyway.
Yeah.
Whereas if you're a really high income earner, maximum tax bracket, really negatively geared on maybe a very expensive a blue chip property that has a low rental yield, your impact
Getting
from the
more
changes will
tax.
be larger.
Yes, yeah. So basically, it impacts people at the highest marginal rate of tax because they've got more tax back that they would have got that they're losing, right?
Yeah.
In terms of trust structures and company structures, what I want to talk about here is so many influencers right now and property gurus are all like, "Don't worry, they've got the secret, right? They've got this secret of just buying in this company structure." And this is what I wanted to talk to you more about, which is trust structures, these guys that had the same secret with trust structures maybe 12 to 18 months ago. What's happened to those trust structures in majority cases? I know it's getting harder for those people to exclude entities. That was the big whole push for trust structures, which was put it in a trust and generally for speaking, right, wealthy people that put them in trust weren't doing it to hide entities for finance, right? Maybe for protection, but not for finance. Now, in terms of trust structures now, for those people that are trying to do it to exclude entities, how much harder has it gotten? And do you think it's going to get harder in the future?
Yeah, I guess that's where sort of, that was a really big push in the last year where this was a big strategy. You can buy a property, you isolate it, you go on to the next one, you can ignore it. Macquarie Bank was the golden child for that, right? Like they were the most liberal with it. They had good rates. There was no penalty. They were really easy to deal with. And then all of a sudden they come out, basically saying they're going to suspend all their trust lending. And then that's sort of shone a spotlight on it for the whole industry. Because obviously there's been a flow on. A lot of the volume was going to Macquarie. Well, then you go to the next best lender and the next best lender. And what we've seen is the big banks curtailing their appetite for that, whether that's just limiting the people that they'll let through the door to do that sort of transaction. Their
Yeah.
LVRs have dropped. Their
Was going to say some
discretionary
of them are saying
pricing.
it's got to be a 70% LVR or they won't lend to you in a trust structure. And then some are saying you've got to be an existing customer for 6 months or so before they do it. So let's just say that you're with Macquarie right now and you no longer can service with Macquarie. You've written this letter. Now all of a sudden you go into principal and interest and you're sitting in that trust. What happens to you if you can't refinance somewhere else?
Well, you're stuck with Macquarie, and it's probably not the worst bank in the world to be stuck with, but you can't roll over your IO terms with them. They're not going to entertain an application of resetting your finance. So you're basically going to be off to a lender that might do it. So you might be knocking on the doors of the big banks, hoping that your LVR's dropped,
Yeah.
so you can do it at 70%. But you might be getting a bump in rates. You might be off to the non-bank lenders to do the deal because they're always going to be wanting to do the deal, but
Higher interest rate.
what cost are they going to do it?
Yeah.
So basically, your options have become vastly limited, and it's carried on and incrementally. Now we're starting to see non-banks put heavier criteria on that letter. They're getting out of it in general, like
In
one
other
to
words, you
eight.
can't write your own letter like you could with Macquarie.
Yep.
You can't have it, I know, because I've done this, which is, have a letter say this entity meets its own commitments from an accountant. It's going to get a lot more stricter with the way that they word it, which means it puts more risk on the accountant to write a letter for you. Um, so they're making it tougher. You're getting harder to move lenders and less lenders of choice. You may have to reduce your LVRs, which means that even if you reduce your LVR, you can never take that beyond, say, 70% or whatever they have on an LVR. So you're trapping equity in that trust. So there's a lot that they're almost like clamping down on it more and more. Like this has only sort of been the start of it in the last sort of 6 months. Everyone's sort of rolling now, obviously, with these negative gearing changes, and they're also saying the capital gains tax changes. They're all talking about buying in company structures now. It's like the new big thing. It's the new trusts, right? Don't worry, buying a company structure, you can get it at 30% flat tax rates. You can then lend money and keep sort of pushing that way. What's your thoughts on company structures? Where do they work and where don't they?
I think it comes down to the individual. I've always been hesitant to push someone to a company and trust unless there's a clear strategy. And usually the strategy is not driven by the borrowing capacity outcome. There's other factors that are driving you to that. You're a business owner, you need asset protection. You're a high income earner and you've got the deposits to play with. And so you're building out a portfolio in a quick succession, or there's usually other driving factors, and then and that's what's making the determining factor, because Yeah, basically, if
Less
you're,
lenders. There's also
yeah,
less
there's,
lenders for companies. Is there less lenders for company structures than there is trust structures?
yeah, and basically
Like,
you're slimming yourself down to maybe a quarter of the panel that you might otherwise have,
yeah.
and
Also, borrowing
you're
capacity. Hasn't some of the banks, didn't Macquarie come out and said company structures now will be whatever the interest rate is plus a 3% buffer at principal and
correct.
interest?
And that's sort of been the cascade of dominoes. It's progressively gotten more and more stricter in one the number of lenders willing to do it and how they're willing to do it. And now Macquarie, under the guise of all the negative gearing stuff, probably people didn't really notice because it hasn't been brought up much, but they've actually brought out a stricter requirement to their accountant's letter. Now it's not just is it able to meet its own commitments, it needs to meet a 3% buffer rate on a P&I repayment over the life of the loan. So in effect, they're bringing the whole loan that you've got inside of Entity
Yep.
into the servicing calculator if you want to use them for any
So
application.
pretty much, let's just say your interest rate's sort of 6.5 to 7%. You could be looking at 9.5 to 10% principal and interest repayment. So if you're looking at that as an entity to try and exclude that entity in the future, you got to try and exclude it on, maybe 9, 10% P&I interest rates, which is going to be super hard to do even at low LVRs. So then you don't really want to do it from an exclusion point of view. Then the next thing is people say, well, I want to do it because I get a flat rate of tax of 30% and my capital gains tax is 30%. The problem that I see with that is, for majority, so that works for people that keep their money within an investment environment,
Yep.
meaning they roll into more investments and they keep doing that, they keep building, keep building, keep building, right? But the moment they decide they want a PPOR, like an owner occupied property, or they need the money personally in any way, they're going to pay top up tax anyway. So they're not really, they're not sitting at 30% taxes. They're delaying the inevitable in taxes. So eventually you're going to have to pay those top up taxes. Eventually you're going to have to get the money out of the company. Very few people will roll their money at 30% and keep it in that investment environment for 30 years. Like, I don't see it very often. It would probably be more beneficial to those very wealthy people that have their own rock, they've paid it off, they've got no
Yep.
issues, their business is churning out a heap of money, and they are sitting those in a generational wealth of assets that they're never going to sell. They don't need the money. Then maybe those company structures work in those aspects. But for the everyday person that's deciding that they're probably going to sell that property within 10 or 15 years, those people probably don't really have, there's not much difference between buying, or I mean, it's probably more beneficial to buy in a trust or even a personal name than it is a company structure with all the added costs. Then if you're buying in personal names, you got to think about what land tax as well, right? So
Yep.
if you're in a company structure, you might get more land tax depending on the state that you're in. You got to pay the setup fees, you got to pay the ongoing fees. So if you're negatively geared, you may be negatively geared even further with all the costs of just maintaining that trust, those company structures, or even trust structures as well. So you got to think of land tax, ongoing costs, whether there's a benefit for you or not. And then everyone says, well, we're going to have issues with serviceability. And it's kind of like, well, you're going to have issues with serviceability in company structures anyway, by the sounds of it, with the buffering. You still will have those issues with trust structures as well. And then personal names, you'll have issues. But we did talk about it, like, the banks are there to protect you in a way, right? Like, if
Mm.
things go sour and go south, you have to be able to pay back the debts over time and be comfortable in what you're doing. Everyone's bullish in a bullish market, but you still have to be careful with what you're doing. And they are there to protect you. And if interest rates go down, your borrowing capacity in your personal name goes up anyway. So you still get that.
Correct.
And you also get a lot more lenders that you can move between and sort of like look at from a maneuverability to go from lender to lender as well. How do you see it?
Yeah, I think it's like a natural progression of where you're at actually in the journey. Like early on, getting that snowball started is about getting, not paying an extra land tax because you bill because, that extra 2 or 3 grand you can save into putting into your next deposit. Picking a lender that's cheaper because you bought it in your personal name rather than a trust might mean that you're saving 0.5% on your interest rate. It's the small things that matter in the start. You're not actually going to get the benefits of the entity structures until you've built up that net worth.
Yeah.
Because on the honest experience is you see clients go, they build up their net worth and they go, okay, I'm making well, and that will translate into an owner occupied at some point.
Yeah,
And
for
so you need
sure.
to get your money out of the assets. And so if you've got it all in this corporate entity, sure, you might have saved tax up to that point. But the moment you need to take it out of those entities,
Top up
where
tech.
you have been better in a position to sell down, buy that owner rock, recycle your equity, take it into another investment cycle, and then maybe we're getting a little bit more creative when we're building out the legacy piece, the what's going to the kids in terms of inheritance, what sort of structure that's going to be in, and that's like you will naturally get to these more complicated structures just by the nature of what you're doing and what you're building over time. It, but if you're already scrimping on cash flow, putting it inside of a trust or a company, not going to help you.
Exactly. You're
Your
going to
cash
get
flow is
worse
going to
cash
be
flow.
this worse, basically.
Exactly. Yeah,
So
that's what I say as well. I think that like this is where an individual tailored strategy needs to be for everyone, and we need to have, people like you that has really good finance strategies in place, particular for different people because each of those entities work, but they also have a downfall, and it depends on the client that we're working with to what way we need to go with them from an entity point of view, whether it's personal trust, whether it's companies. Obviously, we do all of them, but it's working out the pros and cons and whether you're going to get the benefit or the drawback from it. Because some people will end up having all these extra costs for no reason, and they shouldn't be having it. So I think it's also be careful of what you listen to on TikTok. Be careful what you listen to with these gurus trying to sell you into company structures. So yeah, thanks for coming on, Jared. This is just a quick one. We'll do another one maybe in the future. But if you want help with sort of structuring your portfolio, Jared and his team, they can help you out. Just reach out to us at ypw.com.au. We'll put you in touch with them and we can help you build your portfolio. This is what we do every single day. We've been working with Jared and the team for many years. And yeah, you need to get the right advice because you can't go back on it. Once you've done it, you've done it. So I hope everyone gets a little bit of value out of this. So yeah, thanks for coming on, Jared.